The following recording is of a live question and answer session that took place for businesses about the US Employee Retention Credit. So hello everybody, it's really nice to have you along and welcome to this session on the Employee Retention Credit. So I'm your host, Rebecca Harding. I'm based in the UK and this is Chip Hobacker, and he's our expert on the ERC. Now, he's Director of Consulting and Director of Turnaround at the firm Raymond in the US. And he's going to start by giving us an overview of the Employee Retention Credit. Afterwards, there'll be an opportunity to ask questions as well. So if you want to use the Q&A button, which is at the bottom on the right, rather than the chat box, that'd be really helpful. It just helps me keep an eye on everything you want to know. So that'd be brilliant. So Chip, over to you. And you tell us all about it.
Well, good morning, everybody. Thanks for joining. One of the questions I usually start with is just, why are we doing this? And the answer is the Employee Retention Credit, for a lot of reasons, was really misunderstood. It was originally choice between the PPP and the ERC, and then they changed that. There's so many things have changed that we found in the country roughly 40% of the eligible companies that could take this credit haven't, and there's a lot of reasons for that. But one of the common ones we do find is that, especially for our international friends that have U.S. based payroll, the misinformation, the bad information, the changes, questions about eligibility, how do we go about all these different things have just been barriers. And so a little bit of a mini crusade here to try to make sure that everybody can get what they're due from Uncle Sam. But the Employee Retention Credit was originally a scheme designed to provide funding for folks that kept people employed during COVID. So it rolled in during 2020, also there for the first 3 quarters of 2021. And it was a scheme where in 2020, there's a calculation, but ultimately you could get $5,000 ahead for the employees that you kept on. And then in 2021, it went up to $21,000. So a total of $26,000 potentially per person, which is pretty easy math, right? If you have 100 people, it's 2.6 million. If you have 10, it's 260,000. It's not a terribly difficult thing to do if you know what you're doing. So our folks get involved. The process is pretty simple. There's no obligation. We just help with some questions for eligibility and a little estimation, and off we go. But it is just a pure refundable credit, and in most cases, it's about 90 days from the cash. And so that's the brief overview. Beck, anything else you wanted me to add, or is that what you were hoping for?
Oh, I think that's great. But I do know there is if you live on a tropical island, you can also claim the US, which I thought I could probably go and do some research for you if you want to. I'm up for that.
That's true. What Beck is mentioning is one of the other little known details is that employees or employers in U.S. territories also qualify. So Puerto Rico, Guam, the U.S. Virgin Islands, there's actually, I think, 60 some islands that are all out there. And I don't know if that applies to this group or not, but certainly, especially hospitality based industry in those islands, those are all eligible. And it's, again, just not very well discussed or marketed or thought about. And so a missed opportunity for a lot of people.
Yeah, well, we'll talk about that afterwards, shall we, Chip?
Fair enough.
I can carry your bags. I'm good at that. I'm no good at the maths. I'm no good at the maths, which is why I do what I do. You do what
Fair enough.
Do. So, well, I've got some questions as well. Shall I run through some of the questions about it that I've got, and then see if other people want to throw some things? So feel free to throw in a question whenever you want, guys. So if you've taken the payroll protection loan already, could you take this credit as well?
So originally, this was one of the real big misconceptions. When the CARES Act first came out, you had to pick. And so most people did an analysis, and the PPP was likely the better choice. And when the change happened later in 2020, that allowed you to choose one or to do both, no longer exclusive, but now you could do both. That news had already been lost a little bit. And so you can, in fact, take both. There is some harmonization between the forgiveness attributes of the payroll protection program and the qualified wages for the ERC that needs to take place. But if you took the PPP, you almost certainly should take the ERC.
Oh, that's really good advice. So what if you've got an existing accounting firm? Is it going to upset your relationship with them? Because I mean, that would that's going to bother people, I'm sure.
Yeah. So the way that our process works is we aren't trying to supplant anybody. We're just simply trying to supplement. And so again, the go forward from here is a call with one of our partners just to walk through some simple questions around eligibility, and we have a couple of numbers to help get an estimate for the credit. And if it seems commercially viable, that's the point at which we would be engaged to actually help generate it. And happy to just be a one-off and out of the picture, not to upset any of the current relationships. It's again just trying to help folks who haven't taken advantage of this get into it. We do find that if you haven't taken advantage of it, it's probably because your accountants at most dabble in it. Not that there's anything wrong with that. It's a little bit of a specialized area. Again, just like so many firms haven't taken advantage of it, so many CPA firms aren't super up to snuff on it. And so we go in from a very, very soft perspective, trying not to upset anybody's apple carts.
Yeah, excellent. So do you have to reflect that tax credit in the income tax though as well? So how's that going to kick in?
Yeah, so there is some harmonization. It is a tax credit, and you do have to reflect that credit being taken. You have to, the actual mechanism by which you apply for it is amended payroll tax returns. So 941s that are amended, I think they're 941Xs and 940Xs. But then that does have to be reflected. So they're, depending on where you are in your tax cycle, you may have to amend 2020 or 2021.
Right. Oh, we've got a question here. So do the employees still need to be working for the business, he says thus, if they were there throughout 20 and 21, or can we retrospectively claim for employees that have since left? Great question.
It is a great question. So we take a snapshot of who was there in 2020 and 2021. So I'm in the insolvency world a lot of my days, unfortunately. And one of the things that we go and take a look at is, even if we have a business that's in liquidation or winding down today, if in 2020 or 2021 they were employing people, they're eligible, and so we would apply for the credit. And so it is a snapshot of what happened during those particular periods. So you don't have to have them still employed now.
Right. And what about the deadlines? I mean, when are the deadlines for this?
Sure. So these fall under the regular U.S. tax credit criteria. So you have 3 years. So the first quarter that is eligible is I think second quarter of 2020. And so you're 3 years from that. So 2023, you're looking at June 30, 2023 is the latest you can apply for that quarter. And you do apply on a quarter by quarter basis. So If you're eligible for each quarter in 2020 and each quarter in 2021, you're looking at those 5 payroll tax returns. And again, every 90 days, kind of that in 2023 and then 2024, eventually you start running up against those deadlines. So we've got time. We're not up against it, to do something by year end. That said, the sooner you get in, the sooner the IRS processes things and all of that. And, we find, 9 out of 10 applications go through without a hitch. And just like say around 90 days later, the checks start rolling in. But there are a few that need some follow up. And so we do wait kind of that 90 days and then we start chasing, but it's not deadline driven yet, but it will be before much longer.
Right. Okay. So it's 90 days basically, but I'm quite interested in what you say about some being questioned. What sort of questions have you seen on them? Just so people sort of have an awareness of what gets.
Well, I'd like to say they're all questions. Sometimes the IRS just doesn't get them. I mean, there's crazy stories about like entire containers and semi trucks of mail that go missing. And so if we haven't heard from the IRS after those 90 days, we do follow up at the most base level just to make sure they got the mail.
Actually had it.
Yeah.
Well, they opened it because they don't even it's on their desk and in a big file. They've not got through it yet.
Yep. And because they're, unfortunately, in all of the income tax circumstances, we're finding that whether it's payroll tax or just regular tax filings, people mailing in their checks to pay taxes and, having the IRS come after them and starting to put liens on their homes and things, claiming they didn't get paid. And it's just the mail didn't get open. So that's the most base level. There are other questions that sometimes they ask, and so you just sort of have to work through everything. And a certain number of them get pulled for closer review. And so you just want to be able to If you do get pulled, we want to be able to reach out to the IRS and sort of short circuit that and offer ourselves up to be helpful and answer any questions they may have. Very seldom are there any problems with legitimate applications.
Yeah. So I guess it's about the advantage with you knowing a lot about this is that you're going to do an application that's less likely to get questions. That's the bottom line, isn't it? So it's important to know what you're talking about. So we've got another question. If you have a payroll service that files your 941, how do we get them amended?
So most of the large payroll services, like your ADP, Paychex, there's a huge variety of other ones, they've actually got a process for this already. So what would happen is we would simply tell them what our amendments were going to look like. We would still file the amended payroll tax return ourselves, but we would definitely need to bring the payroll companies up to speed so that their records were adjusted and amended. A few of them are a little bit more sophisticated, and they'll actually take care of the filing. We've had mixed results with that, honestly. Sometimes they've been really quality and it's been taken care of, but they're not tax firms; they're payroll firms, and so there's a little bit of a risk that, as I say, something's not quite done or something's not quite right. It gets filed wrong, or doesn't get filed, or it has the wrong form number on because they're not having folks who do this all of the time with these amendments. Go in and do the calculation. So we'd prefer to do the actual filing ourselves, to control the mailing, make sure that we know at least it got sent, and then work with the payroll tax firms to amend their records. And they all do it. I mean, this is fairly standard now. So any payroll firm of any size is going to have a process by which they work with the company's accountants to amend those returns.
So, you talk about that being a risk or something that potentially can go wrong. What are the other risks that people need to look out for when they're doing this?
So there's not an awful lot of risk to it. The biggest risk is just not knowing about it, not taking advantage of it. If you have taken the payroll protection program, as I say, there's some harmonization that you need to have with forgiveness and the calculation. And so you do want to make sure that you've done that properly. You want to make the biggest risks are just, especially, and it seems perhaps a little bit self-interested, but most of the problems that we have been brought into aren't problems where we did the work. They're problems when a client or someone who becomes a client actually tried to do it themselves and they just did something wrong. They filled out the form wrong, put numbers in the wrong lines, got wrong years, did any number of things that went wrong. And then they've gotten a letter back from the IRS with questions. They don't know how to answer them. And so we get brought in from that perspective. Again, we have something like 19,500 corporate clients, and we've done this on, I think, probably 5,500 of them or so have been good qualified candidates. So we've got quite a bit of experience in doing it. And the ones that we've done, again, sometimes you get input error where we simply get bad information from the clients, and that can cause challenges. And there's some risk there. But if you have good information, that's the problem with clients, right? You can't live with them or without
badly
them.
Behaved,
But if you have good information, there's no risk, right? It doesn't increase your risk of audit. It's simply a mechanical activity.
Right. So, if you were coming into my business, what would we do? How would it all work? Is this going to take me a massive amount of time? Because that's always a big issue. Is sort of having you in looking at this. So what's the deal? Come on, Chip.
So it's not going to take you a lot of time. We actually try to make it fairly simple. So the first question is that we'd ask you just around eligibility. And there's really two ways that you get eligible. The first one is, did you have a decline in gross receipts in 2020 and 2021? Lots of companies did. That's an easy thing. Lots of companies didn't, though, right? Lots of companies, they either pivoted well, they already happened to be in a really good marketplace to take advantage of things going on in the pandemic. And so the second question that you come around is, did we have, technical term, partial or full suspension of business operations? And that becomes confusing too, because people hear that and they're like, oh, that means we couldn't work, we were shut down. And that's not it. So partial or full suspension, this is anytime a government order, federal government, state government, city government, provincial government, any there's 50 million kinds of governments, it seems like, but some sort of a government order or proclamation or decree limited the business operations, affected the employer's operations. So easy examples are restaurants. Restaurants maybe had to close its dining room. They still offered carryout and they did delivery services. And in some cases, they pivoted really well and actually did a lot better simply providing that way. But because they had their dining room closed for a period of time or all of the time, they're eligible. Similar thing for, really any kind of business where, if there was some work from home orders, 2 weeks to flatten the curve and we all stayed home, that covers an awful lot of people. So that'd be the first two questions is, did you have a reduction in your gross receipts, or did you have some sort of quote, quote partial suspension? And again, we'd ask some questions around that. And again, it's when you actually delve into what partial suspension is, it's hard to find somebody who didn't have a COVID decree or order or rule impact them. And so that's the first thing we do is say, okay, were you eligible? And then the second thing we'd ask is, all right, how many employees did you have? And the basic to max out the qualification, an employee has to make $10,000 in a quarter. Okay. So you still get credit for less than that. So if you have a bunch of waiters or waitresses that maybe make less, then, that would be one thing. But if you have somebody who essentially makes at least a salary of $40,000 a year, they're going to cap out what that credit is. And so we do some pretty simple math, sometimes on just a napkin at a restaurant, honestly, and say,
okay, sounding like my kind of maths.
Yeah. But just, how many employees did you have that made at least $10,000 a quarter? And again, for 2020, that credit for those folks would end up being $5,000 for the year. And for 2021, it's $7,000 a quarter for the first 3 quarters. So you can fairly quickly get through the math to get a piece of what we think the credit value would be. And then the next thing that we'd ask is, did you take the PPP? Did you have forgiveness? And there's some more complicated things that may get in there. Right. One of the other things that we have to remind people of is with the PPP, there's a difference when that and the employee retention credit. The PPP had some foreign ownership limitations. The employee retention credit has no foreign ownership limitations. Anyone who has U.S.-based payroll meets that criteria. The PPP also had some size limitations. The ERC does not have size limitations as far as the company itself. There's only a limited number of employees that can be taken. You can't have an infinite number of employees. Unfortunately, GM and Ford got capped out. But, those are some of the differences. And I think the PPP was so well publicized and people understood it so well that lots of times if you're foreign owned or had a lot of foreign ownership or you were big, you just sort of checked the box and said, yeah, the ERC is just not something we're eligible for. So we talked through all of those sorts of things. And then assuming, Becca, that you were eligible and that the numbers seemed commercially viable, that's the point at which we'd throw together an engagement letter and say, okay, we think this is what it's going to cost and how long it's going to take. And it's not, generally speaking, these are $5,000 to $10,000 US dollar projects. If it's super complicated, it might be as much as $25,000, but that'd be the cap that I think I've seen for super complicated $10 million credits. So, you're in good shape.
So give us an example of a firm that you've worked for and the kind of returns they've had out of it. Just talk through.
Yeah. So, so we've got a restaurant in Grand Rapids, Michigan. It's a tiki bar, a tiki bar place. And they got themselves into some trouble in 2020, 2021. They actually declared bankruptcy and they were eligible for this. And so I think they had maybe 40 total employees. A lot of them were part-time, of course, busboys, cooks, dishwashers, people like this. But they went into bankruptcy. And of course, cash is always a challenge when you're insolvent like that. They got $480,000 back. And, that really made a big difference for them. They'd actually already emerged out of Chapter 11 on the other side with a confirmed plan when they got that cash, but it's found money that's there. Similarly, a healthcare operation in Detroit, three health clinics, $750,000. And, nice. I'm kind of nonchalant with them because it really is if you know about it, nonchalant. It's not high impact. I don't need 30 hours of your staff's time. You're probably talking about a long lunch for this initial conversation and maybe an hour or two of gathering information, and then the ability to review them and put them in the mail. And that's done.
Yeah. So what about parents like myself who've been impacted by their daughter's liking of Deliveroo since COVID? Is there any conversation with someone like me? I can't get around the habit now. That's the trouble.
Yeah.
I keep going upstairs and like little parcels arrive.
It is, well, it's a shift, right? I mean, it's a shift in dining, a shift in everything. It was one of the things we noticed here. We had lots of folks who were much older who were in-person shoppers before COVID, and not anymore. Now groceries just come to the door and they're just never going back. I mean, it's really an interesting shift.
Yeah. If I can find my credit card, it's always a good thing.
Yeah. You need
the kids have got it. Yeah.
True enough.
So you're talking about, a restaurant there, but is it always simple? If you're a big firm rather than a small firm, are there differences in the way that you approach this apart from the sort of basic scaling of it?
So if you have under 100 employees, there's sort of a easy button, if you will, an easy form. 100 to 500 is a medium form. Over 500 is a little bit more complicated. Again, it's all fairly routine if you do it regularly. Like everything else, it's a bit arcane if you're trying it for the first time, trying to figure something out. And it's especially arcane, honestly, and this is where I think our friends outside of the U.S. borders come in. It's especially arcane if you're from somewhere else in the world trying to figure out U.S. tax forms. Maybe every jurisdiction feels this way, but it seems like the U.S. tax process is far more convoluted than most folks that are fairly straightforward.
Yeah. We've got another couple of questions.
Sure.
If they had part-time working or reduced schedules, which caused employees to be under $10,000 per quarter, do we still qualify? Good question.
Yes. Yeah. Yes. So you cap out at that $10,000. There's a calculation underneath that goes on. So let's just say that rather than $10,000 per quarter, you might make your $5,000. It's essentially the tax credit's worth 50% of the qualified wages for 2020, limited to $10,000 an employee. So if you made $10,000, you'd get that maximum credit of $5,000 for the 2020 cycle. But if you made $5,000, then you'd have a 50% credit of $2,500. So you still do have eligibility for that credit. And that's where, again, it's not terribly complicated, but that's where the maths come in and the spreadsheet come in. If everybody's capped out at 10,000, the math's pretty easy. If you get a lot of people who are underneath that, like in a restaurant situation or lots of part-time employees, you do have to do the math and sort of, work your way through, for each employee, what are they particularly worth in terms of this credit? And of course, that changes for 2021 to $7,000 a quarter.
Right. And the last question we've got is this work done on a contingent basis, i.e. if we weren't eligible, it doesn't cost us anything, or are there costs for the initial conversation?
So we don't do it on a contingent basis, but we also, the first probably 2.5 hours are just conversations. There's no cost, there's no charge, there's no bill for it. Again, it's going to be a Zoom call or a lunch if someone happens to be in the general area that you're at, and it's just that conversation where, again, myself or one of my partners will have these conversations with you, and there's a point at which, we have this conversation. We say, okay, you're eligible. It seems like, just based on the conversation, our napkin style calculation makes it seem like this is a commercially viable thing. Now let's get a little bit more specific information. So we'd probably ask you for, perhaps payroll tax returns. We ask for a little bit of information, and we come up with a pretty good estimate. This is all still in just the conversational phase. Once we actually get to that point where we've now gotten some hard information from you, and we're confident that we can give you a good estimation of what the value is going to be, and give you a good estimation of what the cost is going to be, that's the point at which we'd say, okay, would you like to engage us or not?
Okay.
And honestly, I mean, we're all friends here. There's a risk at that point on us that you at that point say, well, gee, that's great, thanks. We're going to call our other accountants and talk to them, and that happens sometimes. But again, that's part of the crusade we're on, to at least try to help folks understand what's out there and available. So it's not contingent, but there's quite a bit of time in and a fair amount of certainty before we ask to be engaged.
Yeah, no, that makes a lot of sense. So another question, if you had an employee that left partway through the affected period and you replaced the role, would you be able to claim the credit for the new employee?
Sure. Yep. So if you were to imagine a spreadsheet for the second quarter of 2020, we would simply have a list of the people who received pay. So if you have 75 employees, whether they came or went, whatever their payroll was while they were employed during that quarter, we would calculate that quarter's credit from that. So it doesn't matter so much whether they were there the whole time. So it's, again, a little different. You see in the PPP forgiveness calculations, you see some requirements to retain employees and all that sort of stuff. Here it is the employee retention credit, and they're hoping that you retain people, but people come and go during it. And so it's really whatever payroll you had in that quarter, it's qualified, and we calculate based off that, whether they stayed the whole quarter, whether they left partway through the quarter, that doesn't matter. It just matters what someone was paid during a quarter.
Right. Has anybody got any more questions? I haven't got any more from people watching, but I mean, what would your top tips be then, Chip? Your 3 top things that you get people to do straight away.
So honestly, you're probably going to follow up email from one of our helpful folks offering to talk more. And if any of this rings the bells with you, the first tip is push the button. Let's have that conversation. Let's verify that we're eligible, and let's take a quick peek at what we think the value is. And in that, like I say, over a quick lunch or even just a cup of coffee, we can figure out, I think, whether it makes sense to keep talking or not. And sometimes there's just that peace of mind from being able to check it off. Most of the time, these conversations lead to there's something here and it's valuable, and it makes some sense to keep proceeding. Again, as you sit there right now, you probably have an idea how many employees you have with U.S. payroll, and you probably have an idea how many of them make at least $10,000 a quarter, and you probably can just about calculate yourself right now what the upside is. Where it becomes a little bit more complicated is harmonizing the PPP. That's harder to do on the napkin. You need a spreadsheet for that. And so the top tip is just move forward to start with. And from there, we can see what cash is out there. I think the second thing is not waiting too long. Again, there's no urgency to hurry and do it during the holidays or anything like that. But as we get into 2023, we are going to start coming up against some of those deadlines. The big money, though, is 2021, right? It's $5,000 of credit for 2020 wages, $21,000 of credit for 2021 wages. So 2021, where the big money is, that's a 3-year deadline. So that's really a 2024 issue. Mm-hmm. So you do have some time, but again, if it's free money and it's out there,
you want it now.
Do you really want to leave it with the government for an extra year if you can get to it?
No, that's good advice. So you are actually in London, aren't you, next week? Is that a possibility if anybody wants to have a chat sort of in a time that isn't so early for you? The poor old Chip, I had to kick him out of bed at some godforsaken hour this morning to get him here.
Now, you did leave me a WhatsApp message about 4 a.m., which I took as a passive-aggressive way to make sure I was getting up. I will be in London next week. I come in, I guess I'll land on the 7th. The 7th is fairly tied up. I do have some time on the 8th, which is Thursday, and on Monday, the 12th, so I could get together in person. Happy to do that. Happy to talk on the wire. Really easy to do it. Let's see. The question is, does a combined tax return, does each entity need to adjust their 941?
Let's just pop it.
So when you say a combined tax return, I think we're talking about probably a consolidated return. And so if you have, let's say you have 10 entities, one of them is a U.S. entity. That U.S. entity would need to file. If you had 10 different companies in the U.S., each of them would need to apply separately. So it would be 10 different projects. There would be at some point probably a consolidated tax return that would need to get tweaked. If you only took the credit in some entities, the other entities wouldn't have to do anything. But each entity that has a 941 that has payroll that gets a credit is going to have these amended. That's actually the process by which the IRS knows to pay you, is you amend those 941s. So it's that part at least is good to be able to have those extra 941s, because that means the IRS is sending the checks.
Right, that is great. So if anybody's got a last question, perhaps type it in now. And in the meantime, I'm going to get Chip to tell you about his podcast that he's doing.
The cost of the first half hour. Nah, it's just a podcast that we do. It's called Border Crossing. I spend about 120 days a year abroad in a wide variety of business activities. And so what I do find is a lot of times good information that I find out about in one jurisdiction that folks in other jurisdictions need to know about. And so I've got a podcast called Border Crossing, which is just that. It's just kind of this effort to take things that I've found out in one place that I think people in another place might be interested in or might need to know about, and try to succinctly communicate that. We try to keep the podcast down to 15 to 20 minutes at most, which encourages people not falling asleep at the end of them.
Yeah, no, you're very good at being succinct. So we've got one more. Do they take the costs off future tax bills or send the cash back?
So if you want them to apply the credit on a prospective basis, they're happy to do that. The reality is, though, that most people want the money back. So we'll apply for the cash back, and so you literally will get a check per quarter. So these medical clinics in Detroit I mentioned, there's 4 clinics there. We had a 941X, the amended payroll tax return for each of the quarters. And so for each one, we got a check for each quarter that came back. And it's say about 90 days for the first ones we sent in, and a little bit longer for the others. So, you're certainly welcome to look prospectively, but I think I've never found someone who didn't just want the money.
Yeah, no, I'd go for that option. So I think that's everybody's questions now, Chip. So, if they want to get hold of you, we'll email out anyway to see if you want to organise a chat with Chip. But if they want to link with you on LinkedIn, they can do that as well, can't they? Or the Raymond website? Yeah,
you did always find the LinkedIn website's probably the fastest way to hit me up. There's not a lot of Chip Holbeckys running around out there. So if you look for me, you'll find me pretty easily. The Raymond website's fine. It's just raymond.com. And we can connect from there. So appreciate everyone's time and the questions. Hopefully it was useful and helpful. And if it's something that makes sense to look at more, happy to talk more about it.
Yeah, no, that's brilliant. Well, thanks ever so much for joining us, everyone, today. It's been good to have you here. And as I say, we'll be emailing you shortly. So have a great afternoon and have a good Christmas. I can't believe we're into December now, or tomorrow anyway. So it'll be great.
We are. That's probably my wife's going with me to London next week, and I'm coming for business. She's coming for Oxford Street.
Well, I might hang out with her for a bit then. Oh, you take care. So, goodbye, everyone. Have a good afternoon.
Thanks, all.